loan closes with us or closes with other mortgage lenders out there. And we say this to all our real estate agents, not just my KW agents, even though you guys are our biggest account. But if you have a problem somewhere else, call me and let me know, and I may have a solution for you with whoever the lender is. Our goal is to get you paid and get your loans closed. If we ever want an opportunity to work with you, I've got to keep you in business. So, you know, anything we can do to help out, even if we're not making any money off the loan, our goal is to keep you successful. Now, sooner or later, we might get the loan. Other than that, we just want to make sure you guys are successful. So we're going to talk a little bit about the lending and kind of what we do on our end. If you think about lending a little bit, it's kind of like a wheel. And the center of that wheel is the loan officer and the real estate agent. And I'll tell you why in just a minute. But basically what Trinity and I do is every spoke on that wheel contains somebody else that we coordinate the loan closing with. And those spokes can be an appraiser, an insurance agent, contact for the employment. Yeah, Trinity, what else do we contact? Title company, buyer's agent, seller's agent. So there's a lot of people that we have to put together to make that loan work, coordinate. That's why this thing says, you know, it's a team effort. How successful, how smooth, how without hiccups your loan goes on our end depends a lot on the buyer, on how organized and how helpful they are, and the real estate agents too. So it's as long as we all work as a team, that lending process isn't as bad as some of the horror stories that you've heard out there. But you know, Trinity and I definitely don't do it all by ourselves. It's a team effort. The reason I put the loan officer and the real estate agent in the center of this is because, well, and this has changed a little bit over the years, but for the most part, we're the only ones that get paid when the loan closes. Everybody else that touches these folks, title companies, appraisers, insurance agents, for the most part, those are all hourly employees that are getting paid whether that loan closes or not. So Trinity and I are just like you guys, we're 100% commission. Matter of fact, if that home doesn't close, not only do we not make money on it, usually I'll pay for the appraisal because I don't want to put that out on the buyer, so we lose money on it. So a lot of loan officers now are on salaries. We don't do that. We're 100% commission. So when I do a pre-approval letter that says your client is good to go, we put a lot of thought in that because we realize we're going to be working on it for free until it closes. So we want to make sure, just like you guys, that we're going to make it to the other end. So that's kind of how the lending process gets started. Talked a little bit about Trinity and I. She came over and started working with us about 6 years ago. We kind of got in the mortgage business. AMIC has always been able to do purchase business. We have like 60 loan officers over there right now. The majority of them do refinances. We've always been able to do purchases, but it wasn't a business that we targeted. And through some friends and families, the last 5 years, what I call the friends and family program, the business has really picked up. And we started getting friends and family that would call and say, hey, can you do a purchase? And we're like, well, we don't really target that work, but yeah, we can do it. Well, we did a few. And the realtors on both sides really liked what we did, our process. And we said, you know, this may be something to get into. And that's what we did. So we started about 5 years ago. And I think now with AMIC, we do about 3,600 loans a year. Probably 35% of those are purchase business. The rest of them are refinances still. But that's out of 9 states. I was in the Coast Guard for about 13 years before I started doing this. I'm still trying to figure out how I got the mortgage business. And Trinity has an accounting degree from Auburn, so she, you're going to learn if you ever work with us. She does all the work, and I get to do all the talking. That's what happens. Like any other marriage.
Where are you going? Where are you going?
I'll get started on that. She's still mad about the other night. There's another part of our staff. That's Caramel and Brownie. If you guys ever follow us on Facebook, these dogs get more attention. All right, let's get into it. Pre-approval phase and why. We're going to talk about home lending terminology, the home lending programs that are out there, the basic ones. Talk about credit analysis. You know, we have so many people call us up, say, my credit score is this, can I get a loan? I wish it was that easy. I wish that one score dictated everything we needed to do the loan process. But it doesn't. We're going to get into that a little bit, tell you the difference, the variations. Talk about purchase contracts and then the process to close You guys all have all this on the handout in front of you. So please ask any questions. What is a mortgage? I think we all pretty much understand that. It's just basically when the financial backer is somebody other than yourself that you partner with to purchase a home. They're going to hold the mortgage on it. It can be a private mortgage or a bank mortgage. If the terms aren't met, those are the people that can come in and foreclose, repossess the house. Talk a little bit about buying power and break down what it means. What is an acceptable amount of money to spend on a mortgage? It's always a really good question. This stat down here was really updated just in May of 2021. Kind of shocked me a little bit. You know, next couple slides, you see breakdown of it. $1,275 is the average in the United States that someone spends on a mortgage. Now that's just the principal and interest. That's not including your escrow. So down here, if you would throw escrows on top of that, it can vary. Let's just say it's a $2,400 insurance policy. I mean, you're looking at $1,500 or $1,600, you know, for an average mortgage payment. It goes up a little bit at 1,609, but that's not just the 30 years. That's the 10 years, 15s, 20s, 25s, and 30s off the time. The average in the United States is $1,609. Kind of gives you an idea of where your buyers are going. This, you can look at it on the slide. It's going to tell you about what we see per income structure of what people spend on their housing mortgages.
Ashley.
Pretty common is, you know, 150,000 or more, they're spending about $1,600. And as you go down, your mortgage payment goes down. By region, I think you can kind of see why we're getting kind of hit with that higher average number. If you look at the West Coast and the East Coast, of course, property values over there, we all know, are way more than we're seeing here. I think if you've been in the real estate business anytime or plan on being there anytime, you're going to be picking up a lot of buyers from out of state that are headed this way. And that's a big reason why right there. Just the affordability and the buying power. You get so much more house here than you do a lot of other places when you start going up on the East Coast. We're licensed in Colorado and California. Property values is crazy up there right now. Did a house, and this has been a year or so ago, just outside of Los Angeles. It was under 1,000 square feet. I want to say about 900 square feet. It's a block house, had 2 window unit air conditions, and the appraisal come in at $750,000. Yeah, so some crazy values out there for locations. Buying power. So when people come to us, that's basically most of the time. Honestly, by the time we get to one of your clients, they've already got a house in mind, or they, you know, there's so much data out there on the internet now that people start shopping before they start getting pre-approved. So they've already kind of found the house that they're looking for in a price range that they want to be. So they look and they say, you know, I've got $100,000, and then all of a sudden they start looking online. Like, yeah, I'm really liking that $100,000. I'm going to now spend $150,000 or whatever. So they bring the range up. So they kind of tell us what we shoot for when we go to pre-approve it. I always ask them, like, I know you've been looking online at houses. Where are you finding a price point that you like the house? And they'll give us that number. And of course, when we do the pre-approval, I max it out anyway. I'm going to tell them the highest they can afford. But if they already give me that number ahead of time, it's nice to have a goal to go after when we pre-approve. So that means what their buying power is. That's what I'm looking for. What they're able to afford based off of their income at the current time. And that's what we do the pre-approval at. We have a lot of people call us and they're looking for, you know, a mortgage of a $250,000 house. I'll call them back. So we're good to go. Your actual approval is probably $500,000. That means you got to go spend $500,000, which means that's where you rank. Unfortunately, we get people want to buy a $250,000 house, they're qualified for a $100,000 house. Go the other direction. That's why low interest rates are really nice right now to be a part of. The lower the interest rate, the lower that mortgage payment, the more buying power that your buyers have, the more house they can afford with that lower interest rate. Unfortunately, vice versa, as they go back up, and buying power goes down, they'll be able to afford less house for the same amount of money. Each program that we have is going to vary on their debt ratios. Some of the terms we're going to mention in the next few slides. Credit rating, buyer's down payment, source and seasons funds, escrows, HOA, PMI. Everybody here been in the business, what, a year, less than a year? A year or more? Anybody? Okay. So you probably heard these terms if you've been working with any. If not, please just pull a piece of paper, have me, stop me, whatever. I'll be glad to go into it a little bit deeper. But we're going to talk about private mortgage insurance, your debt to income ratios, and your closing costs. 3 companies out there that we use to pull a credit score. Every borrower we pull one credit report, but it has all 3 companies on there: Equifax, Experian, and TransUnion. And what that credit report does is it has a complex algorithm that takes all of the client's debts and the cost of the debts. You know, $10,000 credit card, you got a $5,000 balance. It looks at the balance versus the top of the availability on that credit card. And that algorithm combines all those creditors, all those debtors, and the pay history on it. It's very complex, and it spits out a score. The 3 bureaus use basically the same algorithm, but we come up with 3 different scores the majority of the time. And a lot of that is they report at different times. So when a debtor reports that a payment's been made, and Experian goes in and extracts that data, they issue a score. Well, TransUnion may not come in and extract that data from that debtor for 2 more weeks. So their score is a little bit different because the timing is different of when they extract the data and put it in their algorithm. So that's why you have 3 different credit scores, but for the most part, they're all going to be pretty close, give or take, 10 or 15 points. We pull all 3 bureaus and we use the middle score. So if you've got a 650, a 660, and a 700, your qualifying score is a 660. It's always going to be the middle score. So we use to qualify for whatever program. That'll dictate what program that they go under.
Is that always the best way to look at that, regardless of middle, or does Equifax usually have a little more weight than a TransUnion or an Experian?
They're all the same unless you're out there buying a car somewhere. If you guys have ever bought a vehicle, they'll tell you they only pull 1 bureau, and they're like, we pull TransUnion. So you may have Experian and Equifax be up in the 800s, and your TransUnion is a 700, you're getting that 700. So for us, we put no more weight on one bureau than the other. We simply take whoever that middle score is, regardless of which bureau is reported. There's a lot of non-official credit models out there. This is one of the most aggravating parts of our job. We have so many people call us and say, I want you to give me a quote. My credit score is 725. I'm like, okay. Where did you get your credit score at? Well, freecreditreport.com, Credit Karma. Those are non-official scoring models. They use their own algorithm. I've seen those scores be as far as 100 points off. They are 90% of the time more off than they are on. I can't even think in the last couple of years where I pulled one that was even close to where clients said, and typically they're lower. So I don't like to give rates based off of that, because I want to look at it myself. I don't want to shoot myself in the foot. Guy calls me and says he's got a 650 score and it's really 700, and I give him a quote based on 650, and the next loan officer that talks to him gets to pull his credit, and he says, man, this guy's quote is a lot better than Joe's quote. Well, the data I was using was wrong to give him the quote, so then I've lost that ability to work with the client. And a lot of them don't equate that difference in credit score to the interest rate. So to me, if I'm gonna pre-qualify someone, I want a full report. I want to look at it myself. I want to look at the debt ratios. If they're not ready to do that, I'll ask them to call me back when they are ready to do it. It's just too big of a gamble. Your mortgage is usually the biggest thing that most buyers are going to be investing in, and you just don't want to shoot that in wide ranges. I want to be a little more exact when I give somebody a quote. Down payments, pretty obvious what that is. It's just whatever the borrower puts down on the house they're buying. They can range anywhere from 0% down to 99% down. The typical percent down is 3, 5, 10, 15, or 20%. Your 0% down programs are the only one that we offer is the USDA program. And it's kind of like the ejection seat on a fighter plane, you know, you only use it when you absolutely have to. And the reason I say that is it's a very difficult lending program. The 0% down part of the USDA, I think one of these other slides gets into it, but the 0% down part of the USDA is really good, but it's a specialty program. So what they're doing is allowing you to have that loan. And a lot of buyers feel like, well, you know, I'm gonna be paying this back and I'm paying interest on it. I'm doing something for them. But USDA doesn't look like it. Look at it like that. They're doing something for you. So if they take 60 days to do it for you, that's what you're gonna wait, 60 days, you know, however they do it. There's a double underwrite, which means my guys underwrite it, and then it goes to USDA for a second underwrite. It's very, it's a time-consuming loan. It's one of the strictest loans out there. It's one of the strictest debt ratio loans. But we have people that we do them for. But I usually will not do a USDA loan unless the buyer has the ability for a plan B. Which means if USDA doesn't work out, we can roll them into a different program. That way I keep my pre-approval letter accurate. Our realtors are excited because we've got a loan one way or the other. If you come to me and you're trying to do a USDA loan and that's all you can do, I'm really hesitant to do pre-approval because if USDA denies that, we've got nowhere to go.
What's the advantage of the USDA loan besides the 0%?
That's it.
Why would somebody want to do that anyway? But I don't know, because you got PMI on top of that and everything else.
Sure, but if they don't have the money to buy a house, usually they don't.
So certain properties are
On the certain, that's right, on the certain properties eligible, now they have a loan cap of 280,000, I think it is.
I haven't looked at
That's what I believe.
but there ain't none in one speech.
I bet there is. There was a lot in Mobile. Just wouldn't believe how many people we close loans on it. For me to stereotype, I would get them. So, you know, they buy a house and they've got literally $150 in the bank and they close. It racks my nerves. I'm nervous for them, but we approve those, you know. A lot of times we talk about gift letters and stuff, but families giving them a down payment, so they're just jumping in the house basically with no money. And yeah, it does it. Down payments can come to the buyer, only the buyer. And we talked about gift funds a little bit. So if your family is gifting you the funds, we can go that route as well. The seller can't give you any funds for your down payment. I can't give you any funds for your down payment. That's called a buyer's contribution. The reason they don't do the 0% down like they used to do on a lot of these loans is the ability to foreclose on your house was so easy. A lot of buyers did not have a vested interest, so it was easier to walk away. Studies have shown that even with the 3% down, which that's a first-time buyer program, not everybody gets to do the 3%. Most people do the 5%. Studies have shown greatly that having that much invested, even though it's a small number, kind of keep foreclosure rate a little bit more in line. There's not near as many. The difference between 0% homes and 5% is pretty great. So lenders like to have you have some type of investment in the house. Source and season funds, we'll talk a little bit about that too. It just means where the money is coming from to buy the house. We need to know where that's coming from. The reason is twofold. Like I told you earlier, sellers aren't allowed, and buyers or loan officers aren't allowed to give money to buyers for their down payment. So if you all of a sudden have your bank account runs $100, $200, $300 a month in it on average, and all of a sudden there's $4,000 put in there, we want to know where that came from. It's a cash deposit. So we have to make sure it didn't come from a loan officer trying to help out, the seller trying to get his home sold, so they giving the money to the buyer to give back to them. And the other reason is new debts. So if you go out and borrow that money, say you do a signature loan, we need to know that because now we've got to adjust your debt ratio to show that new loan has been taken out. Sometimes you don't qualify. Your debt ratio was already really tight. So now at this point, your debt ratio goes over the max limit and you can't do any, you don't qualify. So that's why we have to source the funds. Again, unless they're coming from a gift on a conventional gift fund, conventional loan, we don't have to know where it's coming from. We just need a gift letter filled out. We don't have to prove where it's coming from. FHA still requires us to prove where it's coming from. It's always a big deal. We're dealing with this right now on a client, and this comes up all the time. And I'm really kind of trying to decide how I want to start handling it in the future. But we have a client right now that's being gifted funds. The loan actually went really well. 2 weeks, and we were pretty much very close. We just needed to get funds closed. And the dad got in a fight, and they decided it's not giving me the money, so now I don't have the funds. He's trying to come up with them. So a valid question, the real estate agent asked me, and I do this on 90% of our loans, you know, I don't make them show me their closing funds until we get closer to closing. Sometimes that 2 weeks is a big deal for people getting paychecks and stuff, and that's when they have their funds. But I want some kind of reasonable expectation that that money's going to be there. So I'll do a pre-approval without seeing your closing funds. So now this particular Remax agent is like, did the pre-approval, I didn't look at his funds. Technically, he didn't have them. His dad was giving them to him. It was a no-brainer. He and the dad are now invited to do it. But it's still my responsibility to make sure those funds are there. So when we look at the gift funds, you know, that's something we've got to decide if we're going to start making sure they have that up front, rather than a house being taken off the market for 2 or 3 weeks and they've got to have money to buy the house. We just talked about source and season. I just told you why we need to know where that money's coming from, credit reasons. And to make sure that, you know, seller's not giving any money to the buyer. Source means we're just basically showing where it came from. So, for instance, if there's a $2,000 deposit in the account, and I ask the buyer, where did that come from? And he says, my work gave me a bonus this month, then I would want a copy of the check showing it came from work, and that's where it came from. Yes, ma'am.
I know these are not popular, but 401k withdrawals as
Down
down
payments.
payment.
Yep.
How difficult is that?
It's not. We actually do a lot of those, believe it or not. So most people's 401k, if you're buying a primary property, will allow you to extract the money with no penalties to do it. And basically, all we do is show the what we call the 1003. It's our loan application. We give that copy to the buyer. The buyer shows it to his 401k provider. And then all we ask for is a copy of the current 401k statement showing how much money's in there and proof that the money was withdrawn from the 401k. That's basically it. It's pretty simple.
And what about like source cash values and life loan policy?
As long as I can prove where it came from,
Okay.
that's no problem. So you would not believe still in today's time how many people have what we call mattress money. You guys know what that is, right?
Yeah, I had a client that had $30,000.
It doesn't surprise me at all.
And a lot of them lived through the Depression or was a child during the Depression. They don't trust banks.
Yeah.
But it was her mother had died and given her all this cash. And when she said she was gonna, and she had a VA loan, didn't need a lot, but she was buying a little bit higher.
Buy her rate down a little bit.
Yeah, she really should have bought a $230,000 house, and she bought a $250,000 house. And she said that she had the money in cash. You know, you think, yeah, you're right, I'm sure you do. And she did. She went and took and put it in a savings account. But we had to wait so many
Till the
months
season.
until they, you know, she got a statement. We had to wait till she got a statement, but it took 60 days to close anyway. So that literally she took that from that.
Yeah, so money put into your account, even if it's cash,
Mhm.
if it's over 60 days, we don't question it. You know, if it's been in there 60 days. But when it goes, you know, when it's just been put in there a couple weeks ago, yeah, they want to seize and source it, make sure they're up. Yeah, we see it all the time. People have safes. Particularly guy I'm talking about here that dad was giving him the money. He's got some cash, you know, and it's safe. He really needs that. But what we typically do in that case is they find somebody to give them the money, and then they can turn around after closing, give the cash back to them. You know? But yeah, we see it's still a lot of cash floating around out there. FHA is the only program that still requires a bank statement from the owner. I tried to cover this up front, especially with our younger couples that are being gifted funds. Moms and dads hate giving bank statements. I had that thing kill more deals.
Yeah.
And that's There's no way around it. I've tried it a million times. If mom and dad won't give a bank statement showing that they have the current funds to get a 30-day bank statement, you're not going to get that through a paycheck.
We can't black it out either.
Yeah, we still have some couples that want to use black markers to block out their account number and certain deposits. I'm like, you can't do that.
The total balance.
Yeah. Why do you need that? I'm like, you know what? It's FHA requires. I said, but I promise you, we're not going into your account stealing no money. But a lot of people still. Escrows, that's simply whatever your insurance policy for the year is. Your tax premium on that house divided by 12 and it's added to your mortgage payment. So, HOAs go into your debt ratio. We have to know what the HOAs are, especially really big down here on condos, because those things can be pretty expensive. You've got to be able to budget with that, even though it's not going to be part of your monthly payments. It is a debt that you're going to incur when you purchase the house. So you've got to use that amount, make sure it fits into your debt ratio. Private mortgage insurance. So these loans now, this was a really big deal back in 08, 9, 10. We had last count was a little over 7 million foreclosures. As you can tell, I mean, it was a really bad time. Some really big players like Taylor Bean and Whitaker, Countrywide. Those guys were monster companies that all went out of business because of the foreclosure rate. People that really took some beatings on those was the PMI companies, private mortgage insurance. That's actually a company that comes in and says, you know, we're going to back this buyer. We're going to charge them a monthly fee to do it. But if they foreclose, you know, we will take on that debt, pay it off. Well, it's not quite that easy. Like anything else with an insurance company, it takes several years. But if somebody forecloses and they have PMI, the PMI company comes in and says, okay, we want to investigate all of the paperwork. And if they find the slightest little loophole in there, then they say we're not going. And they do. We've had attorneys come down to our office and sit there for weeks going through a lot of paperwork. So when you guys hear us say, man, we need this, we need that, we think the underwriter should be a little bit difficult. That is why, right here, because she's got to make sure, or he's got to make sure that when that loan closes, if anything happens 7, 8, 10 years down the road, and they come back and audit that file, that everything these PMI companies require is in there. Otherwise, it's a buyback. So that's what private mortgage insurance does. It's on all the USDA loans, on all the FHA loans, no matter how much money you put down, it's there. If you do a conventional loan, you put 20% down, you don't have it. Talk about your HOA fees. Everybody knows what HOAs are, right? That's really been a big deal, especially after the storms. You know, it's down here especially because they'll come in and assess buyers. So I could qualify somebody on a condo with a $380 a month HOA fee, and then 2 months later there's been an assessment and now their fees are $700. They're really out of budget. They were already maxing out what they could afford, and now they really have a problem, you know. So that caused a lot especially after Katrina, some of these big storms. HOA dues went up to kind of offset the increase in insurance premiums. A lot of people were having to sell condos or lose condos because now that some of them went from $500 to $1,500. That's a huge increase. In, you know, I mean, even though it's not part of your mortgage payment, it is part of your mortgage payment. You got to pay it every month or annually. That was a big deal for HOAs.
When you're dealing with the condos with the assessments, it's a good idea when you request the documents from them to find out if they have any pending assessments or anything.
Yep.
And that way your buyer is better prepared if they know that that's coming.
That's right. That's right. And usually we'll ask the title company to research that, send us a list of us we can pass on to the buyer. And most of them down here right now actually have pending assessments.
And the other part of that too is with the condo documents and stuff, you'll be able to request what the homeowners association budget is, how much money they have in the bank. You can see how financially healthy that condo is before you put somebody in it, so they don't find themselves in trouble.
That's a nightmare too. Those guys are so overwhelmed, like a lot of people. So we request HOA docs, and maybe 2 weeks where we get it. So we keep moving along with everything else on the loan. then the HOA docs come in and they're in big trouble. They don't have the budget they need like this. You know, that's the tough thing about being a loan officer, a loan originator is we use a best guess, a good faith that based on the data that's being provided to us up front, that we're going to be able to carry this loan through the end. And in 18 years of doing this and you know, 2,300 something closings, I can tell you it's, there's still some curveballs that get thrown at us. HOA is one of them. You know, houses burned down. You have things that you can't control. The tax liens pop up. You're in the middle of this process, and IRS goes and levies the lien. So it's that's some of the fun stuff. The HOA stuff can be getting pretty hairy too.
Isn't the homeowners association traditionally not in the escrow usually?
It's not. We never put it in there. Yeah.
But the problem with that is if they don't pay their HOA,
If I don't need.
they do, yeah, and they can actually foreclose on it.
It could. That would be a really worst case scenario. So we do a lot of purchases where the seller has a lien on the property. So when we request those HOA docs, they come back and say the seller owes us $12,000. Well, at closing, title takes that out of the proceeds and pays the HOA before the seller closes, before the buyer assumes the property. But the assessment stuff coming up, if you're not cute, so a friend of ours just called on Back Bay and just got hit with a $17,000 assessment. I'm like, you're a loan officer. But how did you sleep? He said, man, they told me they were going to get it taken care of, and I didn't ask for it in writing. I was like, wow, $17,000. Like,
What did they have to pay or the?
yeah, he's got to pay it. Said it was written in the contract that it was going to be passed. The seller had to clear it before assuming the contract, but he never went back and checked. Pretty man. There's some big assessments out there right now. This last condo that we had actually kind of fell apart. Is what's the name of it? C Cliff, maybe.
Chase.
Maybe they have a $40 million pending litigation for this.
COs, I hope it's not COs.
No, I don't think CO is, I started about 6 months ago. I was pretty mad too. I'm like, if I was a buyer, I would appreciate it being notified of this. Like, do I want a condo in there that's in a $40 million litigation?
So did the title company, would they have found that?
And so it's on our list that we send to the HOA, fill out, it states on there, are you in mitigation or litigation? If they check either one of those boxes, some of it doesn't matter. Even if you're in it, we'll close on it, depending on what it is. But we have to know what it is. We have to see the legal documentation of what the lawsuit entails. Well, this particular HOA would not provide it, finally in 2 weeks. So we're pulling the loan, got to see something. I said, I don't care what it is, but I really was thinking it was, maybe $100,000 litigation. I had no idea it was $40 million. And when they sent it to us, the attorney, actually, their attorney sent it to us. We were like, but they have 5 buildings. 2 of them got new roofs, the other 3 need, and still have some interior damage from this last storm. So, my God. Now, this was, and we'll get into some of this. This was a non-traditional loan because of all the condo changes. So these were private investors. And with those guys, it's just like if I loan either one of you $20, I can decide how you pay me back. It's my rules, not all these other rules that I'm showing you up here. It's my rules. These private investors that are doing these condos, they do the same thing. They decide what they want. You can hit all their rules, and they can still decide they don't want to lend you the money on the condo. It's their private money. PMI, 20% down on conventional loan gets you out of it. PMI back 5, 6, 8 years ago was a really scary thing for most buyers. And it was expensive because of all the reasons for it. Your typical 800 score buyer that put 10% down had a PMI payment of about $180 a month. That's real money. It's a lot. Those numbers have come way, way down. And I still get so many buyers that call, I don't want that PMI. I want to put down $150,000. Okay, we can do that, but let me show you this with PMI. And their PMI payment is $28 a month. I'm like, so do you want to keep your $50,000 in your bank? You want to pay $28 a month? Some of them still want to put the full amount down, but a lot of them will say, man, $28 a month, I'd rather keep my cash and invest it, and do something like that. So that number has changed significantly to what, from what it was several years ago. The PMI numbers are not that scary at all. The A loans, they have a funding fee, they don't have a, they don't have a monthly PMI, they have one fee that's charged up front, that gets rolled on top of the loan. That's why a lot of people like that loan. It can be kind of expensive depending on the size of your loans. If it's the first time you're using it, it's 2.3% of your loan amount. And then if you use it before, just roll this year, 3.6%. That can, that to income ratio. So your incoming money every month before taxes are taken out, divide, go ahead. Yes, sir.
On the VA, is it still if you're over 30% service connected?
Any disability now, any disability whatsoever. And I know I just hit on that, but I'm gonna go get into that in the next couple of slides.
Okay.
Debt to income ratio, so the money that you got coming in before taxes are taken out each month, divided by your credit reporting debts. So it doesn't take into account your power bill, you know, your water bill, all that kind of stuff. But anything showing up on credit cards, car payments, signature loans, mortgage payments, all of those, that's the, you know, basically you bring in $6,000 a month, your bills are $3,000, your debt ratio is 50%. Student loans too. So even if you're not making any payments on your student loans, depending on the loan program, we have to use a 1% fictitious payment of the balance of your student loan. Freddie Mac requires us to use 0.5%. So we try to qualify you that way if you're doing it. FHA actually just changed a few months ago to 0.5% too, which is big, it's huge, because that has killed a lot of, it's killed a lot of deals, that 1%. Be surprised how much we see in student loans out there. Big numbers.
Can you still, get a mortgage with a student loan then? Having a student loan?
If you budget, so if your student loan is $10,000 and I put a 1% payment in there of that $10,000 and you still stay up under that 50% debt ratio, yeah, we'll do it all day long. But if that fictitious payment that I have to use throws you over that 50%, you won't qualify. Even if it's deferred and you're not making payments on it, we have to assume at some point you're going to start making payments on that student loan, and we have to make sure you can carry that. Teachers are one of the worst. It always makes me feel so bad. You know, $45,000 a year is a good salary for a teacher. Some of their student loans are $150,000, $160,000, and we see it all the time. Biggest one I seen was just the other day was $240,000, but she was a pharmacist. Yeah, that's a lot of money, isn't it? Closing costs. So there's two ways to kind of explain it. When a buyer asks me what closing costs are, I try to give them a true bumper to bumper number, meaning it's when you put your insurance in there, when you put your prorated taxes in there that you're going to pay on the house, your state fees, all that stuff. Sometimes other lenders, when a buyer asks what the closing costs are, they say, well, it's 1%. And what they're doing is quoting their fee, the originator's fee. It's not truly the closing cost. When a buyer says, and a realtor asks, what are the closing costs on this loan? They want to know at the end of the day, with everything together, what it's going to cost them. They don't want to show up at the closing table and say, well, you said closing costs was 1%. Well, yeah, that's all my costs are. But then you have your insurance, you have your state fees, those aren't my costs. Well, the buyer still wanted to know what that number was. You know, it's kind of a misplay of words. So we always give the exact number of what we think, you know, it's going to be at the end of the day, so that there's no surprises. In today's time with RESPA, you send out so much paperwork. If a buyer truly showed up at a closing table not knowing how much his costs were, like I don't even know if that's possible. I don't even think that can happen. They literally sign it about 4 different times before they get to closing, loan estimates and closing disclosures. So that's really kind of it's a change that was made with the RESPA stuff several years ago. It needed to be changed. I think so many of the lending laws that are so cumbersome to us now were so needed. The pendulum may have swung a little bit to overkill on some cases, especially some wood guys. I think they get treated a little bit tougher than what they should. But the changes that we've seen for the most part needed to happen. Changes with the appraisals that we've seen in the last several years needed to happen. It's really what's protecting the market now. Closing costs always has to be, there's no loan programs that allow you to roll closing costs in. It's always coming from the buyer. I can help out with it. I can't help out with down payments, but I can help out as a lender with closing costs. And of course, the seller can donate money to the closing costs as well. But no loan programs have it. Now, USDA allows you to, let's say you're buying a house for $150,000, and the appraisal comes in at $153,000. USDA will allow you to take that $3,000 overage and apply it towards closing costs. So that helps out sometimes with USDA when the appraisal comes in higher than the purchase price. Escrows, that first year of insurance is found.
Question.
Uh-huh.
How do you want us to write now when the seller is going to do a repair that they're not really gonna do? They're gonna pay the buyer to have the money to do the repair after closing? Is the only way to do that is to have the seller pay some of the buyer's closing costs?
That's the only way you can do it. So otherwise, let's say that was fictitious. They're not repairs. You really just give them that money to help out with their down payment. There's no way to dictate truthfully where that money's going after closing. So if they were paying zero closing costs, but giving $4,000 for repairs, and make that $4,000 closing cost money, we don't have to do anything with it, then they can handle the repairs after closing.
But that's the only way to
That's
get
the
their
only-
underwriting is to put.
That's it. You can't have any cash going from the seller to the buyer after closing unless it's been dictated for closing costs. Now, what we do a lot of times is say, right now we're dealing with a lot of roof, still dealing with roof issues. You know, seller needs a new roof. Appraiser goes out, says, you know, you need a roof inspection. Roof inspector comes out and says, yeah, you need a new roof. Seller says, I don't have the money. Well, what we do is try to find a roofing company, which is pretty easy right now, that goes out and actually does the roof, gives us an invoice, and then we pay everything at closing when we close, so that there's no money going back to the seller. Title company's actually paying the contractor that did the roof or whatever those repairs may have been at the time. But yes, after closing, the seller cannot give money to the buyer. You know, first year of insurance is paid up front. That confuses a lot of buyers. They're like, well, you're escrowing me. You're paying this up front. I'm like, yeah, so pay up front means we're covering the first year, but your escrows that you pay when you start making your mortgage payment will cover year two when it rolls around. So that's how that works. So we collect up front for the first, and we go to year two on the second. Fannie Mae, FHA, VA, and USDA. That's the four primary loan programs that we do. Conventional loans, Fannie and Freddie. Typically, for our conventional stuff, we look for a 660 to a high 760 credit score. They go down to 620. That means it's Fannie and Freddie on the conventional side allow down to a 620, but you're going to play hell get one approved unless you've got about $100,000 to put down on the house. Very rare that we see anything below 660 actually. Interest rates today are still vary from 2.75 to 3.75 on loans. They are credit score driven. The higher credit score you have, the better interest rates you get on the convention. Again, the PMI at 20% down. They do have a loan limit cap right now of 548 to 50 and 30 down to 10-year terms. We don't see as many low rates on the 15 years than we used to. It used to be a big difference between 30 years and 15 years. 15 years is not real popular right now. So they got on price not to sell. There's not much difference. I mean, it is a little bit lower, but maybe 1/4%. It used to be 1.5 lower. We'll see that. 45 to 50% debt ratio. Ranges, they cap at 45%, but if you have some assets, a big 401k, something like that, offsets it a little bit. They'll allow you to go up to 50%. First time buyer has to put a minimum of 3% down. Everybody else is 5%. FHA goes down. FHA actually goes down to 500. You won't find very many lenders that go that low. 600 to 680 is kind of that range where I usually qualify people for FHA. Now, I do have clients with 800 scores that we put in the FHA program. And the reason is, if you look down there at the bottom, their debt ratio goes up to 55%. So if I've got a client trying to buy a house and his debt ratio is 53%, I don't care what your score is, you're not going to get that because your debt ratio is over 50%, you're not going to get a conventional. So we offer them an FHA loan, get them in the house. A lot of times they'll take. It's kind of what I was talking about when I started. A lot of people call and say, "I have 650 credit score, can I buy a house?" Well, there's a lot of factors that go into that, other than just your credit score. Debt ratio is one of them. FHA requires a 3.5% down payment. As a minimum, it's got a loan cap as of this year of 356,362. And for the most part, it's not credit driven. So your interest rate is what it is. It's either you qualify or you don't qualify. If you qualify, this is your rate. Whereas conventional is more driven by credit score. Every 20 points on credit score gives you VA loan, again, is from 600 to 800. We do those. 2.25 to 3.5% is kind of the range right now. You have to have a certificate of eligibility. The veteran qualifies for the loan, hasn't had any VA foreclosures. We handle all that on our end. We pull the certificate, tell them they qualify. 2.3% of the loan amount is rolled on top of the VA loan for a first-time use. If you used your VA certificate before, you would have it at 3.6%. Disabled debts have no funding fee. Seems to go up to like $2 million. Anything over that 548 number requires a little bit more underwriting proof, taxes, all that good stuff. 100% financing of the purchase price, but no closing costs are covered. Again, the buyer still has to pay the closing costs, the lender has to pay it. So we talked about the USDA stuff, so I'm not going to go back into that again, but it is one of the strictest loans that we have out there. Debt ratio caps at 41%. Whereas FHA goes to 55, conventional goes to 50. That may not sound like a big number difference, but it is. For most borrowers, it means you're either going to buy a $130,000 house or a $230,000 house. It's a big difference, that 41% of where they cap you at.
So the USDA is for, could it be a lot, or does it have to be a home?
It has to be a home. It actually has to be a residential home on the property, and you can't own any other properties. I have seen some people that inherited a home that's in another state that USDA allowed to go around, but basically it is a program to put you in a house when there is no other program. A guy with $25,000 in the bank, he wanted to go USDA, we took him down that road, got qualified USDA costs. Why are we denying it? So he can do it.
Really?
Yeah.
So if that's like the worst case scenario.
So if it is truly a specialty program to put people in houses that do not have the ability of the Constitution, and that's what happens. If they look at you, you're financially saying, like, this guy had a 780 credit score, $45,000 in the bank. There was no reason he couldn't go conventional, other than he didn't want to do the 5% down. And USDA said no. Because, you know, they run out of money a lot. This is going to be one of the years they probably will do it because of the government shutdown, all that stuff. So,
Is there a max on that house?
yeah, it is. It was not, and that number's wrong. It's 75,000 for a family now of 4 or less. It's 90,600. I'm sorry, I should have changed that. 90,600 is your income. For a family of 4 or 5 or more, it's 109,000. And USDA until this year did not have a loan cap. It just went up to whatever your 41% could afford. That was your loan cap. But now they've actually got a number on it. It's 280,000. What's that?
I've never seen it. Well, I know mobile homes, you can make some upgrades to them and get them changed from being mobile home to considered residential. But FHA loans still sometimes will deny them on that. Is there a particular reason why?
Yeah, it's not a permanent structure. So if you try to do a mobile home, and we don't do them, it's because there's so many variations in them, but a lot of others out there do. It's got to be on a slab. There's got to be a fixed structure, and you have to have an engineering report that states that it's been properly affixed to that slab. So it's considered not real property whenever it's not fixed to the slab. Means we could lend on that, and somebody come in a couple of months and move that mobile home, you know, and then we don't have a single family residential. It's not considered a single family residential home until it's permanently fixed to a slab or break in or the axles removed. There's a lot of things that go into the mobile home. And it's costly on the buyer to get those approved. We tried to jump into them a few years ago because we were seeing a lot of them. I mean, those engineering reports were like $1,100 and $1,500.
That's what I was gonna ask you, where would they get that engineer?
Surveyors do them, and they have contacts for engineering reports to come out and make sure it's properly fixed. But like I said, most of my guys live in Baltimore. I don't have $1,500 to go get this report out.
Yeah.
So we lost more than we gained. We decided it wasn't a good product for us. That's when we put our name on a pre-approval letter. Trinity and I have every intention of making sure it goes to, it goes all 9 innings. We're gonna get you close to the closing day. When I start seeing programs that don't make it, and we start getting them out of our pipeline, because I don't want to disappoint you guys. And I don't want to put the work into it and not close. So that was one of the reasons for that. That's actually one of the reasons for USDA. All the other loan programs, I have a lot of say-so in. I have direct phone numbers. I've been working with the same underwriters for 18 years. I call them on their cell phone. I have a lot of input. With USDA, I do not. I've got no pull. They can say no and not even tell me why. And then I've got to call the buyer and say no, and they go, why? I'm like, I'm not really sure. And I hate it. I can't say it. Good, bad, and ugly of credit. It's not just your credit score, it's actually a totality of what it looks like inside that credit score, why you have a 650, and why you have a 750. We try to look at those. Look at all the foreclosure rates. There's no way you need to know all these numbers. This is something we need to know. I tell everybody with lending, it's kind of like finding a good mechanic for your vehicle. Once you find somebody you trust, I found one in Spanish Fort. I'll drive my vehicle all the way from Orange Beach. I'll drive by 50 other automobile places to get to this guy, because over the last 10 years, he's earned my trust. He could have taken me for a lot more money than he has. I go in there thinking I've got a major problem with my vehicle and it costs me $100 versus I'm thinking 10,000. He's earned my trust. So I take my vehicle to him no matter what. I say the same thing between the realtors and your lenders. When you hand us a loan, you need to have 100% confidence that we're going to do everything you would do to get it to the other end of the table. It's nice to know a little bit about our job. It'll help you in your job. But some of this stuff, we literally read. I've got a guy that does nothing but read changes in mortgage rules and keep us updated on a daily basis. So a lot of this stuff is good for you to know, but understand that we've got it. You hand us this stuff, we're going to make sure that these numbers are met. The credit report needs foreclosure seasonings if there's one there, or whatever loan program that we decide to do this with. Bankruptcies have different seasonings. Chapter 7 to Chapter 13. Chapter 7 starts from the date that it's filed because it's not paid back. Chapter 13 is typically a 3 or 5 year payback. And your seasoning, the time that expires between the time you do a loan and the time it's discharged, that's called your seasoning, is the different years right there, depending on the loan program. That'll show up on your credit report for the most part. We have had cases that it doesn't show up. We'll get underwriters run a background check, so to speak, before closing. Sometimes these things show up. Sometimes other properties that they don't show up, that others report on credit, but we're always running. I tell them my underwriters all the time they should be murder investigators. Man, they find stuff they don't like else find. I don't know how they do it. Purpose of your purchase contract is pretty simple. It gets us started. It tells us the address on it. Interest rate locks are not done on the client. Interest rate locks when we get your purchase contract are done on the address of that property. Should that contract fall through and the buyer go to find another property, we cancel that lock and give them a new lock based on market rate, interest rates, lock on the property they're buying. So when you provide us a purchase contract, that's where we get a loan amount, purchase price, we get the address, we get any seller concessions, earnest money down. So that trigger, that starts the domino effect. Okay, so when we get your purchase contract, that's when we go into putting everything together for the buyer. That's when Trinity goes to work collecting all her data from your buyer. And that's the kind of stuff that she calls and gets from everybody.
Which is all of this provided.
So up until this point, basically the pre-approval has been in good faith between us and the buyer. They tell me how much money they make. And we look at the credit report. I'll ask a few more questions. I'll say, it looks like you're pre-approved for this much. I do that on my W-2, my salary type, hourly type reports. My self-employed buyers, I do make 72 years tax returns, because most of them have no clue what they make. They can make 250,000, but on taxes, they show 30, and they don't really understand what their CPA does. So for self-employed guys, I always make them send me the taxes before I pre-approve them, so I can know exactly what I'm working with on income. Or if I'm asking a buyer that's an hourly or salary employee, he's kind of fumbling around about what he makes, I'll ask for a pay stub just so I can see it. But for the most part, for somebody that seems well organized and says, man, I make $18 an hour, I work 40 hours a week. You know, I put those numbers together. We do the pre-approval based off kind of a good faith discussion. Once the contract comes in, that's when Trinity goes to work, start gathering all that. We start proving the data that was taken during the pre-approval phase.
On the self-employed people, I get they do things for taxes, so forth. Are you able to go back and, I know you don't get too in depth, but are you able to recast those earnings?
Yeah, they can always amend them inside the first year, but then you're talking about it's a process. They have to be, everything you do has to be filed and accepted by the IRS.
Right.
So you can't just go back to your CPA. CPA changes a few things. You said,
Right, I get what you're saying. I mean, my point is you're able to kind of look back and say, okay, yes, yeah, these are write downs, these are depreciations.
that is correct. Yeah, we get a letter typically from the CPA if there's one involved. If not, it's just the buyer. We get a letter from the buyer that there was an erroneous filing of taxes, and we have filed a new report. Here's the new numbers, and then we wait on the IRS to accept those numbers. It's called a 4506. Is what Trinity pulls. So every self-employed buyer that gives us taxes, we don't require it on our W-2 and our hourly type guys. We don't look at taxes anymore. It's stopped about 2 years ago, which is nice. So those things were difficult on some of our W-2 guys as well. But on our self-employed, we not just gather the taxes, but she runs what's called a 4506 form, and it's a verification from the IRS that those taxes have been received and approved. And we have to have that to close.
You have to have 2 years.
2 years. Yeah. And it's gotten a little bit more lenient, but it's still it's one of our tougher programs, on our self-employed guys. But I think people buying houses and starting to realize they can't have quite the write-offs they used to have. They still use the funds to purchase the house. So basically, Trinity starts gathering all that data up. We take and review it, make sure it looks good. And we have a processor in our Spanish court office, actually we have about 15 of them. And they put everything together in a nice little package. All the pay stubs and W-2s, and tax returns, proof of insurance, and all that good stuff. And they send it up to an underwriter. And it takes them about 48 hours right now on reviews. And they send us back and say, "Joe, this looks really good. But we do want you to give us a couple extra things." Always something else that they want. But on a typical stipulation sheet, that may be 1, 2, or 3 things. Or they come back and say, "This is a mess. I need these 15 other things." I'm like, "Oh, well, here we go." Or they find something on that data, the background check, and they issue you a denial. Here's the nice thing about having 18 years and 2,300 closings on your contract. Usually, I have a fix for whatever they send back to us, unless it's something just that's out of my control. Usually, I know what to do. I hate to sound like a farmer's commercial, but I've seen it before. Now, if we're 2 weeks into it, the IRS slaps a $150,000 lien on the client, which I've had happen multiple times. There's nothing I can do about that. It is what it is. We just lose that. For the most part, unless the guy has $150,000, we pay his lien off. But those are the kind of things I can't see. Appraiser goes out and the house is wrecked. I don't ever see the house until I see the appraiser. But for the most part, whatever the underwriter comes up with, 18 years and that many closes, I have usually a little more experience than most of my underwriters have. We have a good crew. Our underwriters, they love to close loans. They don't get paid per unit. Of course, that's illegal, but they have a really good insight as to wanting to close loans, and then they'll typically call me and say, "We got a problem. This is what I would suggest to fix it." I love that. Once they come back and say, "Hey, we've got a couple things we need," boom, we provide those couple things. We send the appraisal in for review. Underwriter comes back and says, "All right, looks good. You're clear for close." That's the favorite word words that you guys like to hear, they were clear for closing. And we talked to the underwriter, I mean, the title company, and we set up your closing. Clients moved into the house, start having cookouts, start referring to all their friends for other purposes. That's kind of how the process works in a nutshell. And they have to start making mortgage payments, all that kind of stuff now. We have a closing department that prepares all the documents that send them to the title company, and that's when they come to you guys instead of the clients. There, it takes about 45 minutes to 2 hours, depending on if they read all the documents or not. Go through your closing. Financing paradise, that's what we do. We live down here now, and we love it. So we can't wait to start doing more business now.
Speaking of paradise, where are you on condo loans, like jumbo loans, that kind of thing?
So here we go with the ejection seat on the fighter plane again. So as you know, all that recently changed.
Right.
Our company had about 100 of them under contract, Fannie Mae approved condos. We lost about 68 of them. It was a nightmare for us financially, a nightmare for our clients, our buyers. And they did come out and say, hey, we're going to put this process in play the next couple of months. They come out and said, boom, as of the first of next month, you're done. Had nowhere else to go with these things. We're starting to see private investors come back into the market. So these condos, most of them that you see on the beach side, there's several that are still Fannie and Freddie approved on this side. There's a couple still on the beach, but for the most part, if they have a check-in desk, condo tail, those types of deals, the HOA isn't budgeted correctly. They're not approved by Fannie. And that is the majority of the stuff that we see on the beach side. It's more of a condo tail, you know. They're saying if a certain percentage of them are on Airbnb or VRBO, which they are, it's about all of them. They're not Fannie and Freddie approved. So private investors are coming back in the market, a lot of them from the West Coast. And they're saying, hey, with 25% now, we'll do these. And Trinidad closed a couple. They close them, but they suck. And I mean, I don't say that loosely. I'm used to turning and burning and closing my loans in 3 weeks. These are 60-day loans. Right.
I got a guy looking at a Phoenix pre-construction right now.
They will close them. I mean, I've got a no income, no work verification, no tax
These
return.
people have money. I mean, they can pay cash. They're just looking, maybe borrowing to put their other funds somewhere else.
Yeah. So we have them. I tell everybody up front, and what I really hate is when a realtor comes to me for the first time and they say, okay, I'm going to send you this condo. So now they think every loan we do is based off of that same thing, and that's just not what we typically do. Our loan programs are a lot smoother and a lot simpler than what these guys do. But basically what they do is they come in and get the appraisal on the property and get a rent schedule of it. And they use that rent schedule to determine whether the property can afford itself. Because they're not using any income or anything for the buyer. They just want the property to be able to support itself. And they've already got 25% down in it. So that takes away some of their gamble. So you're thinking no income, none of that stuff. This should be pretty simple to do. And I thought that too, but they make it more difficult for some reason. It's a non-TRID regulated loan, which just means that they use a different kind of closing pattern most title companies don't have. They have to set the title companies up with it. But at the end of the day, we do close them. It's like pulling teeth. But if you're one of those buyers that doesn't show much on your tax returns, that kind of stuff, it's a pretty good program.
So what's the best program for somebody who's looking not as a primary residence, but they'll live there some, but they're going to rent it out? What's the best option for them as far as getting a mortgage?
So the first thing we look at is the HOA to see if they are Fannie or Freddie approved. If they are, what you're talking about is like a second home person. There is no definition that states how many days a second home must occupy the property. The definition, I just checked this for our person. We have a few investment properties. I checked this with the underwriter the other day. I said, what is the number? So what is? She said, Joe, there's no number. It just says that the buyer must occupy the property at some point throughout the year. So that means I can't do a 12-month lease on some of our stuff, but I can VRBO it. We can go use it 1 weekend a year, meet the requirements of a second home. And the nice thing about it is typically that's a 10% down program versus a 20% down investment program if you get Fannie or Freddie approved in one of these conventions. So of course, the first thing we do is try to get the project approved or see if it is approved. And then it's just your typical conventional loan. There's not much to it other than having a little bit of HOA documentation. But if it comes back and every lender, every underwriting team has a condo review desk, they review all those docs you were talking about earlier, the condo docs that come in, and then come back and tell us if it's approved or not. If they say no, then we jump back over to that other company, it's 25% down if the buyer wants to do it. And then the fun starts.
I've got a person I'm working with now that has available to put down around 200,000. And you're actually one of the ones I told her she need to call. She doesn't know what budget she's at.
Yeah.
And I said, that's the first step before we start looking, find out what your budget is. And let's go from there. There's no point in me showing you something that you can't afford. Let's find out where you're at.
Yeah, that and then you need to know if it's, what the approval rate of the condo is, so you know which loan program you're going to take care of. And I hate to talk about the private investors, but they do, like I said, they close them all, but it's a challenge. It's nothing like your typical lending stuff that we close in 3 weeks. We have a lot of great communication between our processors and underwriters. If there's a problem, it's easy to fix. These private investor guys, maybe you have hell getting them on the phone. It's almost like a USDA program. They consider themselves, they're doing you a favor by doing this loan because nobody else will do it. So you're going to do it at their top. Right? They'll get back to you when they want. If they don't care that your purchase contract's expiring, if that doesn't work, go somewhere else. Chances are, unless you've got cash, there's nowhere else to go.
We're closing with you, we get to go on a boat ride.
That's right. Come on.
Is there a resource page or some way we can find out, like, when we're looking at a condo?
I wish. So there is a condo approval if you go to the Fannie Mae website, but it is so out of date.
Oh, is it?
Yeah. So I almost want to tell you now, if you go on there and look at it and you're on there, great. But if it's not on there, I wouldn't get too nervous. I'd call around and start trying to find somebody to do some research on it, because I want to say probably 80% of the condos that I've approved, Fannie and Freddie, are not on their approval list. I don't know who manages that. It's so far off. It's not even close.
Some of the condo docs are in our MLS as well. If you go ahead and look at.
But your biggest resource for that is your fellow realtors that have closed loans there. I would say your HOA, but turns out that they don't know either, really. But your realtors that are closed in there, ask them what type of program they do. And if they say, hey, we did a conventional loan, then that's going to be a qualified product. If they say, hey, we could not be conventional approved, then it's not going to be a qualified product. So I can find out for you, but it takes about a week for my condo desk to give you an answer because they're so backed up right now. Whereas your fellow realtors should be able to call and say, hey, you closed one in here 3 weeks ago. Can you tell me what kind of loan the buyer did?
Well, you can go in the MLS and pull up what's sold in that complex and find an agent and then you call.
Off the pass right now, Trinity, and I also have a partnership in a company called Surfside Services. It's going to be on your sheet there. About a year ago, we kind of got into this. We found some of our realtors had buyers that had loan reports that they needed off of the inspection sheet, and they were trying to coordinate with all these different contractors to get stuff done. And we said, man, that is just a pain. It's tough to get contractors, as you guys know. So we found some investors that went in with us. We launched this a couple months ago, and it's been really, really good. We've got about 16 trucks on the road right now. We cover everything from electrical, HVAC, plumbing, lawn care, handyman, home cleaning services. We will come out and do one invoice, take care of just about your whole inspection sheet, unless there's something that's absolutely crazy on there. Doing this for a guy right now in Mobile. He had 17 items on his inspection sheet. We're doing all 17 items. One invoice, we're covering it and closed. So that's our Facebook site and that's our website. You guys check it out. Sometimes if you run into any problems with your contractor, a lot of times it's just easy. One, you don't have to hire a plumber, an electrician. We send one person out, they quote the job, there's one invoice. That's it. That's right. It's 10% off. If you let the girl Anna is the girl that will be scheduling all this. Let her know you're one of our clients or one of your buyers or lead client. You guys get 10% off any of our services that we offer.
You said Mobile. I thought you were going to tell us about that guy that just got in trouble over the HVAC.
So my electrician and my plumber just came from him 3 months ago. told me why. They said he's about to get in a lot of trouble. So they're one of our investors. We started talking to them.
He got hammered yesterday.
Yeah, he said he's doing some really bad stuff. And I was kind of like, they're probably just bad employees, you know. I mean, dang, if they wasn't telling the truth, he got hammered. It's about to get worse. From what I understand, it's charging
Yeah, he said the business just got out of hand.
$60 million a month.
Yeah.
So my other investor in this, his name is Chris Olson. He ran the books for them. That's how we knew how much money was. I went to him. I said, this is what I want to do. He said, it's good, lucrative business. These guys are making money. Long story short, we said, let's do it. But yeah, it's Hanson is probably about to go out of business.
They stripped him of their license.
Yeah. $60 million a month. In gross sales. That's it. We're available all the time. We work 7 days a week. We don't have no kids other than those 2 dogs that you've seen up there. So we're always available. Please call. Love to help you out. Like I said, even if it's something we're not working with you on, it's a question you have, I'm glad to answer.
I've got 2 questions. Sometimes out of context, we talk about pre-approval and pre-qualifying. You mentioned it a few different times, different ways. Are they basically the same terminology or?
It is. So what it means is that based off the pre-approval just means I haven't put your data together yet. Pre-qualifying, I can actually send a loan to my underwriting team if I have some questions. Like if you guys had come to me and you said this buyer wants this property, this seller will not take it off the market until the buyer has a full underwriting. That's kind of the pre-qualification. I can send it in for a full underwriting without the appraisal. Of course, we're not going to spend money on an appraisal until we know that we've got an approval. But it can come back with an actual underwriting approval. So mine is a pre-approval, a pre-qualification that says, hey, based off of this data, you'll see on my letter, based off of my research, this client qualifies to $250,000, but underneath that it says we need to go through underwriting, we need an appraisal done. It gives all the checkpoints that I still need to do for a full approval. Well, if you came to me and said, man, this seller will not take a pre-approval, if they want a full approval, we can actually put your buyer through the process before they go under contract, and I can have an underwriting.
And then from a credit score or credit standpoint, you know, I know you got to do anything that's official before. When is that break tack when it comes to pre-approval, pre-qualifying on actually needing to pull that credit in order to, I understand officially putting something down there, but just kind of looking at.
I won't issue a letter unless I seek your credit.
Unless you know. And then how does that affect the buyer? If they don't have a loan with you, they don't go anywhere, I mean, it's a thing, I'm sure it's an inquiry, but, and then what is the length of, for instance, I'll give you me. If I'm wanting to buy a house between today and the next 6-8 months, I have no idea.
Gotcha.
I kind of think I know where I am, but I don't know where I am. But I'm not necessarily ready to pull credit today because I may qualify for a $100,000 house. I may qualify for a $160,000.
Yes.
So I don't necessarily want that ding on me, right? If I'm at a 600 credit score or whatever.
Sure.
So, and that may be a personal question I'll get into later with you.
No, I can answer it. So the credit report's good for 90 days once we pull it.
Okay.
Unlike buying a car or a credit card or something like that, we are a hard hit, but we pull it under a mortgage code that you may see a fluctuation in your credit score of a point, maybe 2 at the max.
Okay.
When we do it, go buy a car, you're going to see a 15-point drop. Most credit cards are about 15-point drop. So we say, listen, if you have intentions of buying a house in the next 6 to 8 months, let us go ahead and pull it. That point or 2 is not going to hurt you enough. And we can have a game plan. If you qualify today, perfect. I'm going to tell you, keep doing exactly what you're doing. If there's some things that you may qualify, but if you do A, B, and C, I may be able to give you a better interest rate. So for that next 6 or 8 months, you can be doing A, B, or C. I always say, if you plan on buying a house that year, let us take a look at it as soon as possible. And we may have, if you don't qualify, I may be able to give you A, B, and C to go do and get you qualified by that 8 months. But we can put a game plan together, you know. And if nothing else, man, you know, difference on conventional between a 700 and a 740 score is about 0.3% on your interest rate. That can equal a lot of money over 30 years. So if we have the time to work on that stuff, I can get you there. Now, if you say, Joe, I found a house, my contract says I got to close in 3 weeks. A lot of times we have to take what we got. We don't have time to get you to where you need to be on a credit score to have a better interest rate. So you may have a 3.25 where you could have had a 2.9 or something like that, you know. But I always tell everybody, let us know ahead of time, and let's get a game plan together. It doesn't hurt my feelings that I'm not gonna be closing you for 8 months. I'll put you in our pipeline and monitor everything and make sure when the time comes up, we're ready to go.
Yes. So from a realtor standpoint, from your standpoint, and from a realtor standpoint, everybody's in the business. So what separates yours and how the closing costs and different things? Is that where is that a negotiable thing based on our clients that are presenting you? Is that based on, you know,
It is.
versus XYZ mortgage company versus closing company? I mean,
So that the way that kind of works, Trina and I are actually partners with AMIC. We own a percentage of the company. So a lot of your loan officers out there are given a rate every day, and they're told by their bosses, this is your interest rate you're going to offer today, and these are the costs you're going to offer. Trina and I we can maneuver that to meet our client. There's several different ways we can get paid on it. Back end, front end, I guess a little bit more technical, but I don't have just a flat 1% fee like a lot of people do. If I'm looking and my buyer says, man, I got $5,000, I try to work with that $5,000. If my 1% fee throws him over that $5,000, I'll back my money down and make that loan work. Realtors that work with us consistently, I can't tell you how many loans we've done for free, and I'm okay with that. I've even done loans where I pay for their appraisal because they couldn't do it. But my point was, when I told you guys when we started, I have to keep you paid, keep you in the business, to never want my turn to come back. Now, the realtors that we do that for, the ones that we cut our profits out of, they typically send me 20 loans a year, so it's not a big deal. I can absorb 1, 2, or 3 of those. You know, if every time you call me, it's that one that I gotta do for free, I can't keep doing that, I can't keep the lights on. But we have the flexibility to price how we want to price. And that's been really good for us. You know, of course, we try to make a little money on our loans, just what we do. We work with you know, the volume and not just try to retire off one home.
But not only that, but like it is it's like our life. So we work all the time, weekends, all the time.
You'll see us on the boat a lot, but we usually have our laptop with us too. So
That's what I'm talking about.
anything else? That took a little longer than I thought.
Yeah, the question is thinking while you're explaining it. So which one comes first, the pre-approval or the pre-qualification?
Typically, if I do a pre-approval for you, you won't see anything else from us until you go under contract. It's very rare. As a matter of fact, in the last 5 years, there's probably been 2 loans that I did a full underwrite on before they went under contract. It's just not something we see. Typically, I've been doing this long enough. I know what questions to ask, and I can read the buyer's demeanor and their level of education. I can tell when they're talking to me if what they're telling me is going to be accurate.
Right.
You know, if they're all over the board, then I'm going to ask for some data before I pre-approve. But if, man, they know exactly what they made last year, they got their W-2 in front of them, they know, you know, and I can just tell from the speaking to them, I'm like, these guys are going to be good. And very rarely does that turn into a problem.